We are joined today by Greg Fatt, Director, Regional Business Development Officer for the Bancorp Institutional Banking Business, and Jim Bolden is Director, Advisor, Finance Manager for the Bancorp Institutional Banking Business. Please submit your questions via the Q&A feature within the Zoom controls at the bottom of your screen. And with that, I'll turn it over to Greg to begin.
Thanks, Kathy, and thanks for everyone for joining. Special thank you for the FPA. We were really excited to be down with you at the conference last month. So thanks for everyone for stopping by our booth. If you're able to do so, or at one of our roundtables, which was a really great event. So thank you for hosting us. So Jim and I are glad to be here, calling you from beautiful Wilmington, Delaware, which is where our institutional banking division is located. Jim and I are typically on the road visiting clients. It's pretty rare that we're both in the office together. We're really happy that Jim is able to join us, as you'll hear from him later. He is and has become one of the experts in financing advisory acquisitions in the industry. He's got a really great scope of expertise on this type of lending, this type of financing. You'll hear all that from him very shortly. As far as some learning objectives we have for the call today, just talk about transition trends in the industry. I'm sure a lot of you are familiar with some of the trends going on, a lot of the mergers and acquisitions that are going on in our business, as financial advisors with mergers going on. We'll talk about some of the common purposes we hear from advisors like yourselves, from your peers, as well as our final point, which I think everyone will be most interested in at the end, is about financing options that are available out in the marketplace for these types of acquisitions that you and your offices may be interested in taking part of. Talk about some of the different structures there. And we'll wrap up. If you haven't heard about the Bancorp, we'll just give you our quick explanation of what we do and how we help financial advisors, not just for financing acquisitions, but also some of the other programs that we offer for advisors. And we'll save it at the end. If anyone has any questions, we'll be sure to monitor some of those as we go through. And we'll get started. So I think some of these numbers will not be a surprise to many of you. There's been a lot of acquisitions going on in especially the RIA space, the independent broker-dealer space, where larger firms are buying out smaller firms. And we're seeing a lot of mergers, which we'll talk about some of the reasons for those coming up in a few slides. But as you see, the number of advisors that are planning to retire in the next 10 years is over 100,000. These are from Cerulli reports. I think, we see these kind of trends going, all in the same direction with the aging advisors out there. And, part of the acquisitions that we talk about with advisors, we help buyers and sellers coordinate these deals for various purposes, whether it's, acquiring other firms or junior people buying into firms that they already work in. So there's a lot of those types of acquisitions. We also see a lot of broker-dealer transitions where broker-dealers are, buying other firms within, their ecosystem. And we think that trend will continue, and we'll talk about some of that coming up here shortly. A lot of the advisors that we speak to on a day-to-day basis, we speak to dozens of advisors every week about acquisitions that they're looking at, acquisitions that are a year away, that are 5 years away. A lot of them are broker-dealer affiliated advisors that are moving to the independent space. We have a lot of firms that are looking to purchase other firms within their broker-dealers. So this is a trend that, we continue to see. And, for senior advisors that are out there, that we're talking to every day with acquisitions, there's a big trend of figuring out the succession planning for a firm. So if a junior advisor is looking to buy into a firm but doesn't have the financing to do so, that's where some of the financing options that we'll talk about really come into play. This is, one of the top topics that we're talking about with our advisors. And we think for advisors, it's really important to talk about with your clients to know that, once you're out of the business, once you're ready for retirement, what's the next step for your business? Who's going to be taking over? How are they going to be managing, the clients that you've helped build up over the years that you've been doing this. We do see, some of these trends. I'm sure you've seen at other conferences. We pull these same figures, but 47%, 50% of industry assets are managed by financial professionals over 55 years old. If you're a younger advisor out there, this is a great time to be in this business. There's going to be a lot of transfer of wealth, transfer of businesses, and that's what we're seeing, come across our desks every day as kind of experts in this field. 1 in 4 financial professionals expect to transition their business, but do not have a succession plan in place. So sellers that are out there are trying to figure out where the buyers are going to come up with the funds to purchase their business, or maybe they have a junior person that's in their business that they're going to, coordinate a deal with. Those are the kind of things that we're looking for and things that we're looking and trying to help with. Another trend here, again, probably not surprising to most of us in the industry. This is looking at the number of deals of over $100 million that are going on in the industry where large firms are buying RIAs or broker-dealer breakoffs in our industry. In 2023 and 2022, there were record numbers of deals being made in this space. And while we don't, while the amount of deals that are over $100 million is relatively small compared to smaller acquisitions, under $100 million, where junior advisors might be buying a senior advisor businesses, or a firm down the street is looking to sell and they're under $100 million. That's probably the majority of the deals. But even in this large space, there were 321 deals in 2023. And we think this trend is going to continue to grow. There's a lot of factors that go into it: interest rates, different financing options, market returns. But regardless of all those things, the trend in the industry here kind of continues. Let's talk about our next topic that we'll touch on here is why are financial advisors buying other practices? Again, we talk with dozens of advisors every week about acquisition plans, different reasons for purchasing other practices. It's a very competitive landscape out there. Something like for every seller, there's 20 or 30 buyers that are interested. And what are some of those reasons? Maybe you've thought of some of these, maybe you haven't, but these are kind of the common ones that we come across, every day. Fast track growth. This is the typical, junior advisor trying to gather assets, and the organic growth method is usually ideal, but it's a slow, meticulous growth pattern that's required there. So we get a lot of advisors that are trying to get from the 50 million to the 100 million assets under management mark, or 100 million to that $200 million mark. Obviously, one of the best ways, the quickest ways, we'll say, to get to that fast track growth is to make an acquisition. Another reason that we're seeing a lot of these acquisitions happening is for geographical expansion. It's no secret different parts of the country are growing quicker and slower. Some financial advisors are making personal life changes to move to different areas. We have a lot of advisors that are moving from the Northeast to the Southeast, for example, in the area that I focus in. From the New York, Philadelphia area, we've got a lot of advisors moving down to Georgia, South Carolina, Florida, as they transition to the next stages of their business and lives. So one of the reasons that we see some acquisitions going on is for that geographical expansion, trying to get a foothold into a certain niche of geographical area to try to get a kickstart in that area. Complementary expertise. This is, when we hear advisors telling us that they want to partner with a CPA firm or a larger firm that does more than just what they do. These are the kind of acquisitions that we're also helping with day to day. Economies of scale. We hear this one all the time, where two senior advisors may want to share an office space. They may want to share administrative resources, technology. So by merging, by coming together on an agreement, economies of scale come into play. And we see many advisors that run these numbers by us, and when we run different estimates of valuations of businesses, that advisors are able to save a lot of money through consolidating resources, right? Taking one of the technology budgets off and just adding another user to an existing technology budget. So economies of scale really come into play here during the acquisitions. Succession planning. This one is my favorite. I really like helping junior advisors get their career started, get into the next phase, get into ownership of the business that they're working in. We get a lot of senior advisors that are telling us, I really want my junior advisor that's been working with me for 5 or 10 years to take over my business, but they just don't have the capital, the $1 million, the $5 million, the $10 million to come up with to buy out my book of business. We love helping these kind of clients. We love seeing these kind of deals happen in the industry because it really helps foster the next generation of financial planners, whether it's tranches, whether it's a full acquisition. These are the kind of deals that we like to see. I don't have a dedicated slide to it, but I'll mention, risks, right? These are all the benefits. These are all the reasons that advisors are buying other businesses. Risks, of course, there's going to be a client loss risk of buying another business. There's going to be some transition steps that occur during that process. But in most cases that we see, just given the trends, those risks are greatly outweighed by some of these benefits that you see. And we've worked with many advisors to keep practices kind of consistent to mitigate a lot of those risks that go into acquiring other firms. I think the section of the presentation that everyone will be most interested in here, and which is really the meat of the conversation, are financing options for practice acquisitions. We speak, again, with dozens of advisors in the industry about different financing options. Advisors come to us with ideas. We come to them with ideas. And, I think, the main point of our conversation here today is to lay out those different options, right? Maybe you've been doing homework on this. Maybe this is your first time exploring or thinking about acquisitions. Hopefully through the next few slides, we'll go through some of the different options that exist out there that advisors come to us with, and pros and cons of different options that are out there. For this section, I'm going to turn it over to Jim Bolden. Again, Jim is one of the industry experts. He's been through the ranks of JP Morgan and Bank of America. He's worked on many deals of financial advisory acquisitions, as well as other commercial loans and other lending products. So he's really the industry expert in this type of business, and we're really happy to have him on. So Jim, I'll turn it over to you.
Great, thank you, Greg. So I want to talk to you guys a little bit specifically about some of the financing options available, and really just not even the options that are available now, but the lack of options that have historically been out there in the marketplace for financial advisors, and kind of what we see changing in the shift. For all the reasons that Greg had just mentioned, advisors, they need options for inorganic growth. They need to merge and acquire. They need to create succession plans, which we'll talk a bit more about in just a minute. Or maybe an advisor, whether a wirehouse or independent, has tied themselves to their broker-dealer via forgivable note. They need to refinance that note in pursuit of greener pastures. Whatever the reason may be, the need for financing is there. It's always been there, but until recently, there really hasn't been a specific conventional financing product tailored to the need. Say advisors and bankers alike are really just starting to understand the value of these firms and the risk or lack thereof of cash flow conventional lending in the space. Say traditionally most deals got done with the use of seller notes, strictly with seller notes, financing from broker dealers, which can be quite expensive, or through private equity options that can generally carry unfavorable terms or unwanted hooks into your business. Or maybe this is the most tragic of all, advisors simply weren't even aware that a large-scale liquidity event was even possible. In addition to some of those options, buyers may have pursued SBA, Small Business Administration guaranteed financing from some national banks, which is one of the options we're showing below, and we'll talk a little bit about. But really, historically, bankers are kind of guilty of not having very creative imaginations. We wanted to know, where are the physical assets? Where's the inventory? Where's the tangible product? It was very difficult for a commercial banker to kind of wrap their arms around the cash flow lending and the collateral required for this type of financing. So now that we've gotten there, we're seeing some conventional lending options out there in the space. And that's not to say that SBA loans don't have their place, because they certainly do. A 7A SBA loan would be excellent for an advisor just starting out their business, or an SBA 504 loan would really be the most appropriate option if you're looking to purchase some physical office space. But the speed and flexibility offered by the conventional lending programs that are arising are really, it's hard to beat in any other case. So to talk specifically about your options for conventional and SBA financing as it pertains to mergers, acquisitions, and the later slides, succession lending and debt refinance, there are some major advantages on the conventional side. They don't necessarily jump off the page at you like on that previous slide. But again, it's going to really come back to the speed and flexibility offered with the conventional financing programs. One of the big disqualifiers in the eyes of the SBA is that the seller in any deal, and this is regardless of the vertical that you're in any business, any industry, the seller is expected to fully exit the business within 12 months following the sale. And again, that works in some instances, but what we found in the advisory space here is that it's a positive for us. We want to see sellers stay on as long as possible after the deal. It makes clients sticky. It makes the deal run smooth. It helps, grow and expand and increase value after the sale. So that's really, what the SBA may see as a disqualifier, we really see as a credit enhancement in our eyes. And again, I think that's where the conventional lending program would shine, because it gives you that flexibility. It creates a lot more opportunity when structuring favorable purchase agreements between buyer and seller. If it's not a 100% sale, or if it is a 100% sale, but the seller would like to stay on and manage some clients, stay on in a consulting capacity, have some sort of earn-out program for future referrals and growth. All of those things are on the table now and can play nicely within the constraints of the conventional financing program. Next up, succession planning. And as Greg mentioned earlier, this is something that we really enjoy helping folks out with. Instead of coasting on autopilot into retirement, we really believe that aging advisors should be getting the next generation involved, empowered, motivated to help grow the value of their firm. There's ways that they can create a liquidity event, in the present by selling a small stake of their firm, again, which is going to motivate that next generation individual. It's going to help add value, help grow the firm, and then when they go to sell additional tranches in the future, or go to sell the entirety of the business and retire, they'll have greater value and will experience an even larger liquidity event at that time. And again, the flexibility of a conventional financing program can really shine here, because you have the opportunity to just sell a small stake, to stay on business as usual, and kind of really build out that long-term plan as you start to think about retirement. I think what we're seeing today, we're seeing a lot of succession planning deals happening, but not in the traditional sense. It's, I'm ready to retire, so now I need to sell 100% of my business to the person that I've been mentoring for the last couple of years. And at that point, some of these firms, it becomes out of reach for that next generation individual to be able to afford financing or reasonably take on a loan of that size. And I think a lot are just guilty, again, of not knowing these options were available, not knowing the value of the firm. Again, we're all still learning a little bit about the space. So now that these kinds of options are available, we're certainly encouraging individuals to start looking at that tranche style structure selling small stakes of ownership over a planned period, getting the next generation involved, get them a manageable loan, and something that they can grow into. And the last one here, refinancing debt, pretty self-explanatory, but basically, if there's any debt on the balance sheet that has been used for business purposes, whether it's a previous SBA loan, most of which were variable rate, by the way, so they have some pretty unfavorable rates at this point, or maybe it was an EIDL loan from the Small Business Administration that comes with a lien on your business. Maybe it's a previous seller note or broker-dealer financing, a forgivable note, whatever it may be, all of those sorts of things are on the table to refinance with a conventional loan. We can roll that into an M&A transaction or another financing request. But if it was used for business purposes prior, it's usually fair game for a debt refi. And this last slide here in my section is an example of an amortization schedule mocked up for an $800,000 conventional loan. And really what we're just trying to show here is some of the free cash flow that can be generated, again, based on the flexibility of the program. It's always in the spirit on the conventional lending side to find a way to make the deal work. Speaking on our behalf and likely on behalf of most banks, it's not just reviewing the numbers. Sorry, it doesn't work. We tried and move on. It's let's find a way to make the cash flow work. Let's find a way to make the deal favorable for all. And with conventional financing options and various amortization options as well, there could very well be a deal structure in there. And that's kind of the sweet spot. It kind of works for bank, buyer, seller, and all gets the deal done.
I'll wrap this section up. One other financing option that advisors come to us with are more, less traditional financing options where clients and advisors are pulling lines of credit from something like a securities-backed line of credit where either the business, your financial advisory practice, or you as an individual have a non-qualified investment account where you're able to leverage those securities as collateral and use that line of credit using your securities as collateral, allowing them to stay invested, get the growth of the market, and using a securities-backed line to assist, aid in, or use the full line of credit as the financing for an acquisition. So, Jim did a really great job pointing out the conventional lending option and SBA lending option, and this just adds to another option that exists out in the marketplace. Some of the benefits of securities-backed loans is that we can oftentimes use them in conjunction with other types of financing. We allow the investments to stay invested when we're using the assets as collateral. Typically, these are a variable rate loan. There's no typically prepayment penalties or fees or maintenance costs. So we've had some instances where advisors come to us with financing options where they're using a traditional or conventional fixed rate loan and also using another line of credit like a securities-backed line that might be a variable line. And this allows advisors in this acquisition space to kind of combine fixed and variable rate loans, different types of lending structures, different types of collateral, basically opening up different options for these types of acquisitions to occur to get lending in the most favorable way, depending on the interest rate environment, depending on each particular situation. So this is basically just another option that advisors are coming to us with as a financing option for them to purchase another firm. We'll wrap up here. We're good up on a half an hour here. So we'll wrap up here. If you haven't heard of the Bancorp Bank, I'll just give you a brief overview about what we do and the space that we work in. Basically, the division that Jim and I work in is up in the top right corner, the institutional bank. We help financial advisors with many different niche lending products. You won't find us in the mortgage or HELOC space, but we do have specialty niche lending and banking programs for financial advisors, whether it's RIAs, independent broker-dealers, two of the big niches that we focus on, basically bringing banking services to non-banks. So use an advisor, your broker-dealer, your RIA is likely not a bank, and that's where we step in to provide banking services for clients. We're the #1 prepaid card issuer in the country, so a lot of those gift cards that you buy at your local stores or Visa gift cards that are preloaded, we are typically, if you flip over the back of those, you'll see our name on the back of those. We work with many of the largest investment companies out in the country in various capacities. You may see some firms that you're familiar with here or that you've worked with or work for currently. And, we've really established ourselves in the background largely without any branches, physical branches. We've always been a kind of a digital bank with a digital footprint, but we work across the country on many different programs and services. I'll turn it over to Jim just to talk about the financing program that we offer here at the Bancorp, just to talk about some of the highlights of what we may be able to help you with if you're interested in an acquisition.
Yeah, thanks, Craig. While we're certainly still a robust SBA lender here and a nationally preferred SBA lender at the bank, we did build out our own conventional lending program a few years back. It was early 2020 when we got up and running and first launched. We've since grown over the years $325 million or so, $350 million, or so in credit facilities originated to date. About 124 individual unique facilities. Most of those term loans, we've worked in some revolving type facilities for working capital when needed, and kind of colored outside the lines a little bit as required. Our average loan size continues to hover around $2 million, and we're here at the Bancorp originating loans anywhere from $500,000 to about $15 million. So really covering the full spectrum, anything from that succession loan for a small book of business to funding an acquisition for a major RIA player out there in the space. So it's been a tremendous program for us. The portfolio has performed exceptionally well, and we love the space and have a very strong appetite for continued growth and expansion. To talk a little bit, without diving too far into the weeds, about how the actual program works and the financing option that we've built out here. Again, most of our loans, they're standard term loans. We're typically originating them on a 7-year term with a 10-year amortization schedule. So you get a little bit more favorable of a monthly payment in exchange for that balloon payment due at the end of 7 years. It's a fixed rate program for the life of the loan. Minimum loan amount of $500,000, which we mentioned a second ago. And importantly, the last box here highlights the collateral for the loan. Where an SBA loan might be looking to take, an SBA lender may be looking to take a lien directly on personal assets or require a cash down payment of some sort. Conventional financing doesn't typically require any liens on your personal property, and we're able to get up and down on a financing request without any mandatory down payment, deposit. You can fund one of these loans without any cash out of pocket if we're hitting appropriate loan to values. So it's, again, all in the spirit of being flexible for this program. And the fees are pretty transparent, 2% origination fee, standard flat closing fee, typically of around $5,500. And then, some ancillary costs are built in there for credit reports, UCC filings, that sort of thing. We're happy to roll in the cost of a business valuation or some working capital to cover maybe some legal expenses incurred with the transaction, those sorts of things. So, again, tons of flexibility and the speed in which we can get up and down on these conventional loans is also an advantage for us.
And Jim mentioned one point about working lines of capital. And that seems to be a real attractive option for financial advisors in this space. As you look at different acquisitions, as you look at different financing options, that's one thing that we recommend all of our advisors take a look at is figuring out working lines of capital, because typically with these types of loans, other financing, other lending options may or may not be as accessible. And by having working lines of capital for things like real estate or employee costs, technology fees, those working lines tend to be a very attractive option for financial advisors to take advantage of in this space. Well, I think we'll wrap it up here and we'll open it up for questions. I know there was a question about sharing the slides. I believe Kathy and the FPA will do that in case there's anything that you want to go back and reference through this deck. I'll also mention, one other thing that we see financial advisors requesting from us and other banks and other financing options is a qualification letter. That's something that we can help put together with pre-approval for a line of credit as you go out and search for deals. Because of the competitiveness of this industry, we find that many advisors, if they can come to a deal with a pre-approval letter with some information from the bank that they're working with to prove that they have financing available for the acquisition, that's something that we've helped many advisors with, to really come to the table to an acquisition and say, yes, I have the $1 million, I have the $5 million, I have the $10 million line of credit lending facility ready to go for this acquisition. It's not that they're going to scrape together these funds or don't have a set plan. And we think that's a real differentiator for advisors that are going into these acquisitions. My contact information is listed on the screen now. If you do have any questions about next steps, thinking about an acquisition, figuring out if your business would qualify for one of these types of loans, discuss the different financing options that we discussed here, the SBA, the conventional, the securities-backed lines, or any other options that you're looking at, we'd be happy to dive through those. I'll open it up here for any questions from the group. I think we have one other appendix slide if we needed to dive in there. So we do have some other things if it gets there, but I'll open it up to the floor here if there are any follow-up questions that we can help answer.
Thanks, Greg. I don't see anything as of now. Would you like to go ahead with the appendix and talk a little bit further? Offer some additional information? Okay.
Yes, yeah. So this appendix slide goes through some more details about our loan structure. I'll let Jim maybe touch on some of the highlights here about, if you're wondering whether you'll qualify, how we qualify financial advisors, this will go through some of those details.
Thanks, Greg. So as mentioned earlier, these are cash flow conventional loans. So really the cash flow, the revenue generated by the business, that is our sole source of repayment and what we're largely underwriting against. We tend to look at these things on a global basis, meaning, we understand that a lot of advisors, it's not just revenue generated or reported directly through the business. There's lots of Schedule C types of income out there as well, other investment opportunities. So we take all of that into consideration, and we need to do two things during our underwriting. We need to come up with an acceptable debt service coverage ratio, which is not unlike any other lending program out there, and we need to hit our loan to value. And the loan to value that we require, it's 70% or less, and we actually refer to it as a loan to enterprise value, really meaning that we're just going to take the value of the buyer's book of business and we're going to take the value of the seller's book of business and we're going to lend up to 70% of that total amount. And as mentioned earlier, if you're hitting that loan to value requirement, you can obtain financing and close a loan really without any cash out of pocket. We're not going to require any down payment at that point. You're welcome to still build things like seller notes into the deal if the seller wants to carry a portion of the financing, either because they're looking for future income or to offset capital gains, or you're preferring that to actually keep them more invested in the deal post-sale. All of those things are still on the table, but if we're hitting that 70% loan to value, then we can provide all the financing needed without any cash out of pocket. And the sole collateral really for one of these loans is just a blanket UCC lien filed on the business. Again, the SBA program, it certainly has its place, especially for advisors just getting started. But in those instances, you're likely going to be asked to pledge, a lien on your home or some other personal assets to help make the deal work. If you're going to qualify for the conventional loan, then we're typically just going to place a blanket UCC lien on the business. It just speaks to our belief in the value of that list of clients in the business that you've built. And then we're going to ask that any owner of the business provide a personal guarantee. And really what that is, it's a promise to pay. It's not our right to any specific collateral. It is not us filing or completing a security agreement against any specific piece of collateral. It's just a promise from you to repay the loan. And then at the bottom here, Greg spoke a little bit about line of credit for working capital, which is something we've begun to develop as we get more involved in the program and deeper into the space, realizing that a lot of advisory firms are likely billing quarterly, but they may have to float some monthly expenses. If we have a blanket UCC lien on your business, it could be very difficult to go out and obtain financing elsewhere. So we're starting to build out some supplemental offerings to the program to continue to help our advisors out.
And I did get a question I saw in the Q&A, so thank you for the question. The question goes around valuing a practice. So who's responsible for that? Are there general equations, that kind of thing? Yes, so the valuation of the business, we typically recommend going to a third-party valuation service provider. There are a few out there. If you're interested in our recommendations and partners that we work with, that we accept for our financing, we'd be happy to share those to you through a follow-up call. As the financing, as one of the lenders in this space, we almost want to keep an arm's length reach from the business valuation. We want to make sure that it's a true third-party valuation based on the value and scope of the business. So we typically rely on our partners to do that valuation, and that is a required step typically for any kind of conventional loan, that there would be some kind of valuation made. And Jim, I don't know if you want to add anything to that.
No, that was well said, Greg. And a lot of times on the banking side, what we'll do in the meantime before evaluation is in hand is we may estimate the value based on a multiple of top-line revenue. We're seeing that multiple grow as well over the years as the secret gets out and the value is more understood in these firms. And as a kind of a good back of the napkin method, a 3 times multiplier on top line revenue for a good recurring book of business usually gets you in the ballpark. And that can kind of get us going on the underwriting side until we have that business valuation come in. And it's also not to say that we're going to limit the financing request or mandate the sale price match that valuation exactly. We understand that there's reasons to pay an amount different from that exact valuation amount, whether it be geographical, or really any reason that you're interested in this particular purchase. So for us, it's more about understanding the value and understanding the purchase price, how the contract is built out, and then going from there.
Any other questions? Feel free to use the chat or the Q&A feature there. We'll leave it open for another minute. If not, running up on 50 minutes here. be happy to help answer any other questions. Again, I've left my contact info on the screen. If anyone has any follow-up questions about a deal they're looking at, different financing options, we're happy to help answer that. If we don't get any other questions, Kathy, thank you for organizing the event. Thank you for all our participants and everyone that's attended. Yeah, and we're happy to help anywhere we can.
Thanks so much, Greg and Jim, for this very informative presentation. And thanks to everyone who connected with us today. Look for an event survey and replay along with this PowerPoint deck to follow. Thanks so much and have a great day.